Let's start Chapter 7. Chapter 7 is about bonds and their valuation. The overview of bonds is very much based on terminology first. There's many types of bonds, and so we'll spend some time talking about the key features and then obviously some number crunching stuff too about how to value a bond. So let's keep in mind what a bond is, and this is a corporate finance class. So we're looking at bonds from the perspective of corporations issue them, and then somebody else buys them. And when they buy a bond, they're essentially lending money to the corporation. Now, not just corporations issue bonds. School districts issue bonds, cities issue bonds, states issue bonds, and so on. So just kind of keep in mind, though, that corporations, governments issue bonds, and then somebody buys those bonds, which is, in a sense, borrowing money from the company that issued the bonds. So the terminology, and this is just some of it, and there's quite a bit. So I would encourage you, as you are reading through your book, if you have the ebook, which I think most of you do, when you see a term in your chapter that's kind of bold and underlined, click on that and a little pop-up will show up giving you the definition. So if you're reading something along your ebook, just make sure that you click on those bolded words so that you know exactly what the definition is. So the key feature of a bond, par value, is the face amount of the bond, the amount paid at maturity. So you'll see the term of being either par value or face value, and it means the same thing. Different books will use different terms. Some might call it a face value, some will call it a par value. Mostly in the examples we go through, they just use the base of $1,000. Now, keep in mind that it's more normal that companies are issuing millions of dollars worth of bonds. For example, the city of Sioux Falls about a year ago was authorized to issue bonds. I should actually say the school district was issued bonds to pay for the new high school and do some renovations for middle schools and elementary schools also. And that was in the millions of dollars. So it's more common that you'll do these in the millions. It's just easier as we go through and do examples just to go through and do thousands. Okay, so it's just more of a convenience thing. Then they talk about what they mean the coupon interest rate. Stated interest rate, generally fixed, paid by the issuer. So the coupon rate is the rate printed on the bond contract. And that's the amount that drives the dollar amount of interest that will get paid. Okay, so that's what that means. So coupon rate is fixed, doesn't change, printed on the contract, that drives the dollar amount of interest paid. Maturity date is when the debt matures, when the bond matures, and that's when the principal is paid back. Issue date is just simply the date that the bond is issued. And yield to maturity, also called YTM, is the rate of return earned on a bond held until its maturity, called the promised yield. And quite often that's a different rate than the coupon rate, because when bonds are bought and sold on the market, whatever the current interest rate environment is what drives that. So it's very common that the coupon interest rate is different than the market rate of interest. So just like the stock market goes up and down every day, interest rates change every day. Now, not as dramatically as maybe stocks can change, but interest rates change, and as interest rates change, that directly impacts the price of a bond. And so it's very common that an interest rate on the market is different than the coupon interest rate. So other features of a bond, a convertible bond may be exchanged for a company's stock at the holder's option, so the bondholder can make that decision. A warrant is a long-term option to buy a stated number of shares of stock at a specified price. A puttable bond, it allows the holder to sell the bond back to the company prior to maturity. An income bond pays interest only when interest is earned by the firm, so the company has to have a certain amount of earnings before they will pay the interest on the bond. And an index bond is an interest rate paid based on the rate of inflation. So if inflation goes up or down, the rate of interest on that bond that it will pay will go up and down. And then a lot of bonds are what they call callable. And a callable bond allows the bond issuer to literally recall the bond. Basically to say, we have the right to exercise the power to buy the bond back from anybody who's bought it from us. Obviously, it's in the contract. Helps the issuer, but hurts the investor. So bond investors, obviously when they buy these, and if the interest rates change and become more favorable for the issuer, they know that the bonds will get called. And so that's not as favorable for the investors. So the investor is looking for a reason, to invest in these. So what callable bonds generally do is have a call provision. And the call provision is an extra amount that the issuing company will pay to the bondholder. So, when a company is issuing bonds, it needs people to buy them, right? That's the whole goal, is you're looking for somebody to lend you money. And so the terms have to be favorable for both sides. However, if interest rates in the economy begin to climb, corporations, they would prefer to not have to pay the extra interest, right? So that's what the call issue is about. It's like, it kind of gives you the ability to refinance a mortgage. If you own a home and mortgage rates start to fall, let's say you've been in your house for 5 years and interest rates all of a sudden have been falling, and you can refinance your home at a lower interest rate, generally your payment may go down a couple $100 a month. And, generally, that's something you would want to take advantage of. So it's kind of the same thing for a corporation. And a sinking fund is a provision set aside to pay off a loan over its life rather than all at maturity. So keep in mind with bonds, the way they work, let's just say a corporation issues a 30-year bond. That's when you pay back the principal. It's not like a car payment or a house payment where you're making monthly payments and each of your payment goes to principal and interest. It's quite different than that. When a corporation issues bonds, it pays interest at least once per year, but the corporation does not pay the principal until the bond matures, which could be 30 years from now. And so investors like protections because, we got to make sure this company will be around in 30 years from now and that it will have the cash to pay off the bonds. So what corporations can do to reduce risk is set up what they call a sinking fund. They don't have to. It's in the bond contract if they do this or not. And so what this means is they're contractually obligated to set a certain amount of money aside every year with a trustee. And so when the bond matures, the cash is sitting right there at a trustee's account in a bank, ready to pay off the bonds. Or sometimes what happens is, let's just say it's a 10-year bond. And a company will say every year we'll randomly call back 10% of the bonds. So we'll just kind of put all the bonds in a hopper, pull 10% of them out and say, those are the ones we're buying back this year. So those are the reasons for that. So the key with those, of course, is they reduce risk to the investor and they shorten maturity depending on how they're set up. And I kind of already mentioned a couple of ways to do this. So, and a company could also just buy a certain percent of bonds off the market and basically just say, instead of saying we'll call 10% back, we'll just every year we'll buy a certain dollar amount of bonds off the market. So let's think of the cash flows for a bond. And now that we've done the time value chapter, you should understand this one. Today is time 0. And then we've got a series of cash flows. So CF 1, 2, and then up to N. And N just being the number of periods. So the value of any financial asset, bond or stock, is based on future cash flows brought back down to today times 0 at some interest rate, which is the R% right there. Now, this is a long one, and this shows us what goes into determining what the interest rate of a bond is. So R is interest rate, the discount rate, basically the opportunity cost of capital basically the rate that could be earned on alternative investments of equal risk, right? There's all kinds of investments out there. And so if we choose to invest in one thing, that means we don't have money to invest in something else. Okay, so what this does is it explains what the various components of the interest rates are. So R star, the one right here with the asterisk, it's easy to think that is as R star. R star is the risk-free rate, and the risk-free rate is generally considered to be the interest rate of a 10-year treasury bond. And the reason we use a 10-year treasury bond is it's obviously issued by the federal government. A treasury bond is issued by the federal government, and it's considered to be risk-free. So R star is the risk-free rate. If you buy a 10-year treasury bond, you bought a risk-free investment. IP is inflation premium. Basically, the more inflation there is, the higher the interest rates will be. MRP is market risk premium. Basically, what's just the interest rate in the market. DRP is default risk premium, the odds of any company that's issued a bond defaulting, not being able to pay back debt. And LP is liquidity premium. So all those components go into determining what the interest rate is on a bond. So now the question is, what's the value of a 10-year, 10% annual coupon bond if R sub D is 10%? So R sub D is basically the market, or the interest rate on that bond, determined by all of these factors right here. Okay, so basically what we're saying is a bond's got that 10% coupon, that the amount printed on the bond contract, and then R sub D is kind of more the market rate of interest for bonds like this one. And so the value of this bond at time 0 is all the future payments brought back to today. And so if we think about a $1,000 bond, and this does not say it's $1,000, but all the examples are just based on this being $1,000. And so if you take 10% times 1,000, that's all, we all know that's $100. So if I have a bond, so let's say I'm the bond investor, I buy this bond, I want to know what's the value of this bond today. Well, the value of this bond today is the cash flows that I'm going to receive. So I buy it today, and then in a year, I'll receive $100 interest, in year 2 another $100, and I'll receive that $100 for 10 years. Also in the 10th year, I'll receive the $1,000 principal back. So I buy the bond today, and then every year for 10 years I get $100. The 10th year I get my $1,000 back. So the present value of all those cash flows brought back to today is $1,000. And the reason it's $1,000 is the market rate of interest and the coupon rate of interest were exactly the same. That's why. So that goes into how do we compute the value. So remember the Excel file that I had you use for the present value chapter. It's the same stuff. It's the same calculations. Bonds are ordinary annuities. So whenever I'm calculating the value of a bond, just think of the present value of an ordinary annuity is what this is. So this shows us all the entries. This is all the keystrokes on a financial calculator, which you can easily turn into the amounts to plug into my Excel spreadsheet that I had you guys use for the time value of money calculation. So present value of an ordinary annuity is what I use to calculate this. Now we'll look at this differently and go, let's change up one thing. And it says, same bond, same situation. However, this time the market rate of interest is 13, or I'm sorry, the annual coupon rate is 13%. Let me say that right. So it says the coupon's 130. So 13% times $1,000 is $130. And it says we're going to assume the previous yield, that R sub D is still 10%. Okay, so 10-year bond, 10N. The interest rate per year is the market rate of interest. I/YR is based on the market rate of interest, R sub D. The payment is based on the coupon. The coupon's 13%, so that's 130. 13% times 1,000 is 130. And then $1,000 maturity future value. Present value of all that is 1,184. So keep in mind that was above $1,000. And let's think about the reason why. This bond pays 13%. The market pays 10%. So this bond pays a higher rate of interest than the market does. That makes the bond worth more than $1,000. So because the coupon rate is higher than the market rate, it's worth more than $1,000. Now we'll kind of flip the script here and go, the coupon rate now is 7%. The market rate of interest is still 10%. So otherwise, kind of the same situation. So it's still a 10-year bond. The market rate of interest is still 10, but the payment is only 70. 7% times 1,000 is 70. Future value is 1,000. Present value is lower than 1,000, $815.66. So again, kind of think about why that is. If I were to go and buy an investment today in the market, I get 10%. This bond only pays 7%. So I'm not going to pay full price for this bond. I'm going to pay a lower amount, which then gets me to the 10%. So I'm going to pay $815 today. When the bond matures, I still get $1,000. And of course, I still get the $100 every year also for 10 years. Okay, so over time, those bonds, we have to amortize them. And you probably remember that, a lot of you, from your accounting principles classes. And so over time, these bonds have to be amortized. And when the bond matures, it basically has to get down to that $1,000 amount. So just kind of keep that in mind too. So, as we've got 10 years to maturity, there's a big difference. But every year we get closer and closer to maturity, that difference declines, and then it becomes no difference at all when the bond matures. Okay, so and I kind of already mentioned that at maturity, the bond must equal its par value. And if R sub D is constant, which what I showed you is we just had 3 examples at 10%. So I showed you an example where the coupon rate and the market rate were the same. I showed you where the coupon rate was higher than the market. I showed you where the coupon rate was lower than the market. And so that affects the price of the bond. So just kind of keep in mind, bond prices are directly impacted by the market rate of interest. And kind of doing the same thing here. What's YTM? So now we're going to solve for yield to maturity. Kind of keep in mind, it's just like the present value, future value chapter. As long as I have all but one component of a calculation, I can solve for what's missing. And so in this one, they're told us it's a 10-year bond, 9% coupon, $1,000 par, sells for $887 today. So we'll solve for the interest rate. So yield to maturity is the interest rate on the market. If I buy that bond today for $887 and I get $90 a year for 10 years and $1,000 principal back in the 10th year, that's worth, what's the interest rate on that? I mean, how do I solve for that? And with a financial calculator, obviously, whatever the last button you enter is the answer. In the Excel file that I gave you for present value, future value, I have a section that you solve for I, and that's solving using the rate formula. And so this gives us a rate of 10.91. So it's just solving for the interest rate using the rate formula. And YTM is the yield on a bond, assuming that I own it until maturity. And so we'll kind of just change it up just a little bit and say, okay, now let's just change the price of the bond to $1,134, still 10 years, still a payment of $90, still a future value of $1,000. And so now we get down to the interest rate per year of 7.08. Okay, so still using the rate formula. And then some more definitions. So when you buy a bond, you kind of expect 2 things. The biggest thing you expect, of course, is the interest payment. That's called the current yield. You would also expect, though, maybe a component of capital gains. And so the current yield is taking your annual coupon payment divided by the current price. The capital gain yield is the change in price divided by the beginning price. and the sum, the expected return, which is your yield to maturity, is broken down into two components, the current yield and the capital gain yield. Now it says expected, that's what we expect to happen the day we buy the bond. Doesn't mean it will happen, but that's what we expect based on what we know on the day we buy the bond. So an example then, so with one of the examples we've already looked at, the coupon rate was 9%. We buy the bond for $8.87, so the current yield then becomes 10.15. And the current yield plus the capital gains yield is the yield to maturity. Well, usually with most bonds, we buy a bond and we know exactly what the YTM is. We'll calculate that. And so on this example, we had calculated a YTM of 10.91. The current yield is 10.15. The difference is 0.76, which is the capital gains yield. So that's actually the way you probably will solve for that the most, is we know the yield to maturity. We know the current yield pretty easily. We can just back into the capital gain yield. And notice that it's small, and that's very common for most bonds. Most of the yield on a bond is going to be based on the current yield. This shows us the concept of price risk, and does a 1-year or a 10-year bond have more price risk? And what this shows us is, let's just take 3 different interest rates with a bond that just has 1 year left until maturity, and compare that to a bond that has 10 years left until maturity. And so 3 different R sub Ds, the market rates of interest, 5, 10, and 15. And notice that the price change in 1 year is not very significant. $48 here, $44 here. But when I get to this being a 10-year bond, notice that the differences are larger, $386 and $251. So the longer until maturity, the greater the interest rate changes will change the price of the bonds. That's the price risk. So the longer the time to maturity, the greater that price risk will impact the price, or the rate of interest rates will impact the price of my bonds. And so they charted those 3 numbers for the 1 year and the 10-year, and we get this right here. So the 1-year bonds in blue, it barely moves. The 10-year bonds in red, and obviously we can see some significant changes. Then reinvestment risk is the concern that if R sub D falls, and as we receive future cash flows, as we receive interest payments and bonds mature and we receive the principal back, now we have cash to reinvest, and if interest rates fall, we don't get the future bigger yields. So the example they give us is we won the lottery, and we win $500,000, and our goal then is to invest that and just live off the interest. So we'll invest the principal and live off of the interest. And so we've got a couple of choices to make as we decide how to invest this $500,000. One of the choices is invest in a 10-year bond or a series of 10 1-year bonds. Both the 10-year and the 1 bond yield 10% as of today, the day we're making the decision. And let's just choose the 1-year bond strategy, and obviously 10% times 500,000 is 50,000. So if I do that at the end of year 1, I will have $50,000. Now the problem though is if interest rates fall after that year is over and they're now 3%, now the issue is that I have to reinvest at 3% and get $15,000. Okay, so that would be the issue. Now they gave us a very dramatic change on purpose to drive the point home. Normally you wouldn't see that dramatic of an interest rate change in 1 year. So if I chose the 10-year bond strategy and I could lock up a 10-year bond at 10%, then I would have $50,000 a year for 10 years already locked up. So assuming it's not callable, of course. So that's the issue, is I have to make those kind of decisions. And investors have to do that all the time. So keep in mind that bond investors are insurance companies, pension funds, mutual funds, If you've got a 401k and you've got money in a bond fund, there's a good chance that you own bonds. And so the people who run these bond funds and these companies that are investing cash for other people have to make those kind of decisions on a daily basis and make projections of what interest rates will do in the future and buy and sell bonds based on that. So the key here is reinvestment risk. Short-term and or high coupon bonds have low price risk but high reinvestment risk, and we flip that for long-term or low coupon bonds. So nothing is riskless is the conclusion, and the goal is to have kind of a happy medium, right? So if you kind of have the right mix of everything between short-term, long-term, high coupon, low coupon, you'll be okay. So it's just a matter of balancing out your portfolio. So one of the last things we need to talk about is semi-annual and what that means. So keep in mind that bonds are issued, and then we talked about making interest payments once per year. Well, in reality, most bonds pay interest every 6 months. That's actually the norm for bonds. So semi-annual means twice per year, or every 6 months. So if I have to take an annual, convert it to a semi-annual, I just follow a few steps. It's really easy to do. I multiply the years by 2. So if it's a 10-year bond and it's a semi-annual coupon or semi-annual interest payments, 2 times 10 is 20. I divide the annual rate, which is the nominal rate, by 2. So if it's a 10% bond, I divide it by 2 and I get 5%. I divide the coupon payment by 2. So let's say the coupon payment was 10% also, so it's $100. I divide that by 2, it's $50. And the future value is fine. I don't do anything with that one. So it's 2n. My interest rate per year is divided by 2. The present value I don't do anything with. The coupon payment I divide by 2. Okay, so it'll show us that now with a 13% bond. So it's a 10-year, 10% semi-annual coupon. Market rate of interest is 13. So 10 times 2 is 20. The 13% R sub D is divided by 2 to get 6.5. The payment is $100, 10% times 1,000. I divide that by 2 for 50. The future value is still 1,000. The present value is $834.72. So when you do your homework and you're looking at a problem and you see that it says semi-annual, or it might mention every 6 months or twice per year, it doesn't always say semi-annual, just watch the wording and just know, no, I'll have to use this method right here. And so the question then is, what would you prefer if you're an investor? Do you want an annual coupon or do you want a semi-annual coupon? What do you want? Well, the more compounding there is as an investor, the higher the interest rate. Okay, so that's the effect formula. So that was on the Excel file that I gave you for the present value, future value chapter, the effect formula. And if you use that, and you go 10 annual at 2 compounding periods, you get 10.25. So the effective rate is actually 10.25, which is obviously higher than 10%. And so they kind of just show us now, by if we just plug in that amount, how does that affect the price of the bond? So I'm just going to just show you that one real quick. One I do need to show you, and you'll get some problems about this one, is what they call yield to call. So I've got a 10-year, 10% semi-annual coupon bond, and it sells for $1,135.90 today. That's the price today. And it can be called in 4 years for $1,050, and an extra $50 is the call premium. So it's still a $1,000 bond, but there's this call premium that says if the corporation buys the bond back within the call period, they'll pay us an extra $50. So what's the yield to call? So we're not solving for YTM, we're solving for yield to call, because we want to figure out if we buy the bond today and we expect it to get called in 4 years, we're not going to own it until it matures. We're only going to own it until it gets called back. And so it's 4 years. So we have to do this based on 4 years now. So 4 times 2 is 8. So 4 times 2 is 8. Present value is the price of the bond today. So what I paid for the bond today, the $1,135.90. The payment is the 10% coupon, semi-annual, so 10% times 1,000 is 100, divided by 2 is 50, and the future value is the 1,050, the call premium, the extra $50 for the call premium. And so I solve for that, and I get interest rate per year is 3.568. Now, however, I have to double that. So the key, and I'm using the rate formula. Now, because I solved this using the semi-annual calculation, which I have to, it's a semi-annual bond, and you get this kind of a question in your homework, you have to double the answer. So I have to take that 3.568 and multiply it by 2. And that's what they're telling us right here. So the yield to call is just double that, so I get 7.137. And the effective rate, then, if I have to figure that out, is I plug in that 7.137, and I can put that into the effect formula, and I get 7.26. So the effective rate is 7.26. So if I bought these bonds, what would I expect to earn? The yield to maturity or the yield to call? The coupon rate's 10. Yield to call was 7.137. So it's safe to say that this company most likely would call them, sell new bonds, and pay the old bonds off because they would save interest, right? So instead of paying $100 per year of interest, they'd pay only $71.37 per year. So I would expect that because YTM was 8, yield to call was 7.137. 7.137 is lower than 8. 7.137 is lower than 10. These bonds will get called. The company will just reissue the bonds. It totally makes sense. Okay, and so generally, whoops, I didn't mean to do that one. When's a call more likely to occur? In general, if a bond sells at a premium, the coupon rate's greater than R sub D, a call is more likely. So generally, you'd expect a yield to call on premium bonds, and you generally expect to hold the bonds that you buy at a discount until they mature. And then default risk is when I mentioned that. Remember that when you buy bonds from a corporation, there is a chance that that corporation will default. And obviously, it works for municipalities too. Municipalities can go into bankruptcy. So it's possible that you buy bonds from a corporation or a government that cannot afford to pay them back. Okay, that's called default. And so any entity that issues a bond goes through what they call a ratings agency, and Moody's and S&P are a couple of the more popular ones. And they give your company a grade. And so they review your current financial condition, history, they project the future a little bit, and they basically say, what are the odds of you being able to pay off your debt as it matures? And they give you a grade. And it's just kind of like academics, A, B, C, and so on. And so you can see what the grades are. So when you get down to the BA category, it's called a junk bond, where the risk of default is high. Investment grade is the A and the B category. Okay, so kind of just keep that in mind. And so what affects default risk and bond ratings? Well, these ratings agencies are looking at a lot of ratios, debt ratio, times interest earned ratio, the current ratio. They're also looking at the bond contract terms. If debt is secured, that means there's some financial asset that the corporation owns that is pledged as collateral to the bond. So if it's a building, some asset of some sort, obviously the bond is not risky, right? The odds of getting paid back go up dramatically. Then what they call senior versus subordinated debt. And that's kind of just ranking the order of who gets paid. Senior debt means anybody with senior debt gets paid first. Subordinated debt has to wait in the back of the line. A guarantee and sinking fund provision, so any kind of guarantees or sinking fund set aside for that bond issue, obviously the odds of getting paid go up dramatically. And then debt maturity. The longer the years to wait, the riskier the bond is, right? A 30-year bond has more risk than a 5-year bond. Other things that affect default risk, Miscellaneous and qualitative factors, earning stability. Does this company have stable earnings that typically go up every year? How regulated is the industry? Sometimes the government will decide to, pick on an industry or find bad actors in an industry and deal with them. Some companies have to deal with antitrust issues. You kind of look at big tech right now. There might be some antitrust issues or product liabilities. Are there pension liabilities to deal with, labor problems to deal with? Those all come into play because all those things affect earnings. And obviously, we're looking at potentially 30 years from now. So if those things are problems or issues, we have to worry about that. And so companies can choose bankruptcy. And there's two kinds of bankruptcy, Chapter 11 and Chapter 7. You'll have questions about both. Obviously, for both of them, it just means we cannot meet our obligations. In Chapter 11, a company will seek protection from the courts. And under Chapter 11, it'll stop creditors from foreclosing, taking assets, and closing the business. And you basically have 120 days to file a reorganization plan. The court appoints a trustee to supervise the reorganization. Management stays in control, but the trustee has to approve a lot of things that that management will do, especially when it comes to money. And the company must demonstrate that its plan that the company's worth more alive than dead. And that's generally what most courts will try to get to, is some kind of a Chapter 11 where the company still exists in some way, shape, or form, because that means people are employed, right? So we're looking for Chapter 11. Most companies are, most courts are, because the court will generally take the position you're better off alive than dead, because that means you have employment. You're hiring people and so on. Even if it's not as many people as before, it's more people than if you totally shut down the doors. But if the courts doesn't believe that's possible, it's just too dire of a situation, then you would go into Chapter 7. And so when a company declares bankruptcy and begins to liquidate, just think there's a line of people outside the door with their hand out, okay? And the line forms based on who you are. And so if you're a secured creditor, so I'm a bondholder, and the bond that I bought was backed by some asset. I'm just waiting for that asset to get sold so I can get paid, right? And I'm going to get a lot of my money back. Trustees get paid, wages within certain limits, taxes, and then we get down to the people that probably won't get a lot. Unfunded pension liabilities, unsecured creditors, preferred stock, and common stock. So, what you get is going to be based on where you are in line. If you're back in the back of the line, odds are you will not get very much. Okay, so in a liquidation, unsecured creditors generally get nothing. Okay, this makes them more willing to participate in the reorganization. So most unsecured creditors would prefer Chapter 11 because they get something back. If it goes to a Chapter 7, most likely they get nothing back. Now, so what happens is groups of creditors get a vote on the reorganization plan, and the judge has to approve it, and there's always negotiations back and forth. So generally what may happen under Chapter 11 is the company emerges from bankruptcy. Some debts have been written off. Some of the creditors have just said, I'm willing to accept a loss. I want something, but I'm realizing I won't get everything back. And so what that does is, by lowering the debts, the company can handle this new debt balance. Less cash has to get paid to pay off that debt. Less cash has to be paid for interest and so on. And basically would have a chance for success. So that's generally what happens is Chapter 11. But you will have to deal with questions between Chapter 11 and Chapter 7 and knowing the differences.